Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for December 12th, 2015. Market is in sideways normal conditions on an annual basis using weekly RSI 14. We are in the middle of neutral with a score of 47 out of 100. On a 10-day basis using the 10-day NDX, we're oversold at 4 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is sideways yellow at minus 1.62%. The slope of the 50 still remains green, bullish at 0.65. ADX 14 is neutral with respect to strength of trend at 19. And the risk index, which is the 30-period moving average of the VIX divided by the 10-period, comes in at a score of 0.919. which puts us into risk off because it's below that threshold of 1.0. The risk Z-score takes that number, 0.919, compares it to the last 5,000 trading days, and computes the standard deviation and the average. And we can compute a Z-score called the risk Z, and that's at minus 1.03. Here's a 90-day histogram of that indicator. You can see that we had a 4 sigma sell-off, a 3 sigma improvement, down to 1 sigma sell-off, just broke above the zero line and is now decayed back to 1.0. That puts the market in a critical state for potential panic reactions, or we need to see about 3 or 4 days of recovery for that indicator to roll back up. So we're at a critical state in terms of volatility. You can see the blended monthly rebalancing current holdings, and then the leaders in the various ETF portfolios based on the prices on Friday. In ETF 2, theoretical exposure of the model is at 10%. The model portfolio itself is at 80% with stops in place. I'll just flash through the ETF portfolios now using blended monthly rebalancing numbers. You can see that only treasuries, U.S. real estate, and U.S. tech, and the diamonds are in the above their 4-month moving average here. So about 3/4 of both ETF 13 and 32 are below their 4-month moving average. These are the winners on the blended monthly score from ETF Max, which is about 1,000 ETFs. You can see that even the leaders mostly hit the wall this week, the exception being some of these interest-bearing ETFs like the zero coupon treasuries and the extended duration treasury index at Vanguard. S&P 500, these are the leaders from the S&P 500. There's some a few winners like DuPont on news of the merger with Dow, but just about everything else is below average. Southwest Airlines took a real big hit here at minus 12%. The market health check, the vertical blue lines are 10, 20, and 30 days of look back. The horizontal purple lines are support levels that are now resistant, used to be support, are now resistance, and they are targets to the upside. You can see the horizontal red lines, those are support levels that have held in the past. We're hovering right on the edge of one at 202 here. If this collapses, then moves to 199, 196, and 188 are in store. You can see that the slope of the 30-period regression line, that's this sine wave, peaked here, has now dropped below the dashed zero line, so the slope of the 30 is negative. That's the black line. And the slope of the 10 is also even more negative. We've sold off almost 5% from the swing high around 212, which has been a barrier for further progress for the last 6 months. You see jaws of PPO have opened to the downside, and on the Williams percent R, we are in oversold conditions. With price hovering right at the Z -3 level, again, critical state in terms of statistical location. The last time it was here, there was a nice rebound up to 212. As the previous time, it found support and moved to 212. If this collapses, then the last time it collapsed, it went from 202 to 195 in a matter of 2 days. So let's keep our risk measured and powder dry there. See, everything except U.S. tech are on cash signals in the ETF2. Technology and consumer staples are well above average in the S&P. Everything in the U.S. is above average except for small cap balanced. Technology is exceptionally strong. China, U.S. real estate, tech, and staples are the only winners out here. Commodities and oil continue to tank. The rest of Asia is below average with the exception of Korea. All the emerging markets, Latin America, Western Hemisphere, and Europe are below average except for the Euro-Asia growth. Using the ETF2 lens, we've got a new winner here in consumer staples. It's green and white. Otherwise, the technology, real estate are dominating. And the rest of the market's starting to get weak. When you see white and green, that means discretionary, semis, financial preferreds, all that is experiencing weakness. In the Dow 30, you can see the DuPont, Microsoft, McDonald's, General Electric all leading the way. Procter & Gamble moving up the stack. Only Caterpillar in the red down here. So the U.S. large caps remain an area of strength. Moving to the daily. A ton of quality signals here in the auto framer. We got a bunch of channeling and overreaction systems, a lot of 5DDs. Got a 551W in General Electric and in Walmart. About half the Dow is on RSI2 signals, and we got some good frog quality numbers in here as well. Almost all of the ETF 30s are on better than 2 to 1 on the auto framer, and I get a couple channeling and overreactions, half a dozen 5DDs, some good frog quality numbers, and then lots of signals on the RSI2. Auto framer with key price levels and the regression line fractal framework. The relative strength leaders remain McDonald's, DuPont, Intel, Procter & Gamble, Microsoft. The deep value plays, IBM, Pfizer, Disney, Caterpillar, and Cisco. Here are the daily squeezes. It's setting up well based on opportunities for one-day pops. You can see here in the market mosaic the S&P testing this price level at 202. The slope of the 30. This has been very nice swing trading moves inside here. And you can see that the slope of the 30 continues to decay. It is now below the 6-month average. In the z-scores of the regression lines, you can see that the 10 has dropped out of the river. The 90 is starting to roll over at the upper limit of the +1 sigma band. And the 30 has now moved from 3 positive sigmas down to almost 1 full negative sigma. You see we're testing, again, 202, and we collapsed out the bottom of the out of the bottom of the river. Failure to get above this 212 was crucial. Just want to show the tightness of the correlation in the major indices. This sell-off has now brought all of the broad indexes back to almost a 2.5 sigma tightness in terms of correlation. That means the the all of the indexes are going down together, so that tightens up their correlation. When the market is grinding up, you see a divergence in the performance of indexes, and then how sharply this moved to the upside is an indication of how strong the sell-off has been globally. Okay, that's everything I want to cover for this weekend. Again, get the market right. Make sure your stops are in place. Be ready for one-day intraday opportunities in this sideways normal. It only takes a couple days of volatility to drop another 5 to 8%. By the same token, we could see that kind of a bounce going forward. So this is going to be day trader prime time for intraday trading. Take good care. Keep your risk measured and your powder dry.